The gold market isn't just hot right now, it's absolutely molten. We've seen the price of 10 grams cross that huge 1.25 lakh mark. And frankly, that has completely changed the conversation. We're not really asking if gold will keep climbing anymore. The question now is how high and, how fast. So for this deep dive, we've gone through a whole stack of expert analysis. We're talking institutional forecasts, market strategist notes, historical data, and we've boiled it all down to one mission, and that's to give you a clear, actionable picture of the possible gold price targets for 2026. If you're an investor, a buyer, or just trying to understand what this massive global flight to safety is all about, this is the essential roadmap.
What's fascinating here is the sheer consensus we're seeing across the board. Every single outlook confirms the trend is bullish. It's firmly in place. But, and this is a huge but, they all come with this massive asterisk. The price path is not going to be a straight line. The speed at which gold climbs depends entirely on, well, a handful of very volatile, almost chaotic global factors that are driving everything right now.
Right, and that's the critical difference. It's why we need to unpack the why before we get to the where.
Yeah.
This isn't just about jewelry demand pushing prices up, it's something bigger. It's a systemic global reaction. So let's jump into those core drivers. Why, fundamentally, is global demand for gold surging like this?
Well, gold has always functioned as the world's most reliable hedge against systemic risk. And right now, the system feels really stressed. The analysis points to four major pillars that are basically holding up these historic prices. So the first pillar is the persistence of high inflation. I mean, despite everything central banks have tried, it just remains sticky. When you look at the real purchasing power of currencies like the dollar, the euro, and yes, the rupee,
Right.
it's eroding, and it's eroding faster than people are comfortable with. Gold, which, has no counterparty risk and can't be just printed out of thin air, it automatically becomes the go-to store of value when confidence in government money starts to wobble.
And that leads directly to the second pillar, doesn't it? Interest rate uncertainty. The market is just desperate to figure out what central banks, especially the US Fed, are going to do next. Are they going to cut? Hike again? This volatility, this just sheer uncertainty, it sends investors running from stocks and from bonds looking for safety.
Exactly. I mean, when the bond market, which is traditionally the safest place to be, becomes this unpredictable, gold's appeal just skyrockets. But the next two factors, they speak to even deeper, more structural problems than just inflation.
So how do these last two, geopolitical stress and what the central banks are doing, how do they turn that global anxiety into actual physical demand?
Geopolitical tensions are the third pillar. When conflicts flare up, whether it's a trade war or an actual military conflict, the risk premium on everything just goes up. Risk assets get sold off. But what's critical here is that these tensions create what the sources call a flight to safety. And it's not just individual investors, it's nation states. And this leads directly to the fourth and, I would argue, the most powerful driver right now: record gold buying by central banks. We're seeing major financial institutions, especially in emerging economies, aggressively adding physical gold to their reserves. This isn't small stuff. They're buying at rates we haven't seen since the post-World War II era.
But why now? I mean, central banks have always held gold. What's with the sudden acceleration?
It's a direct response to that geopolitical friction we just talked about. It's about risk. Central banks are trying to diversify away from holding massive US dollar reserves. They see gold as this crucial buffer against something called sovereign risk.
Okay, let's pause on that term because it's a really important insight. What does sovereign risk actually mean in simple terms for our listeners?
To put it simply, it's the risk that a foreign government, in this case mainly the US, might use its financial system as a weapon. Think about what happened with the freezing of Russia's central bank assets. That sent a shockwave through the world. Nations realized that dollar reserves held in US banks aren't, truly secure if political relationships go sour. So to counter that risk, the risk of your assets being frozen, countries are going back to gold. It's an asset you physically hold in your own vault. It's completely outside the control of any foreign government. That is a huge structural driver. It won't just disappear overnight.
Wow, that completely reframes the whole discussion. This isn't some speculative bubble. It's a reaction to a fundamental crack in global trust. So you have these four massive forces: inflation, rate uncertainty, geopolitical stress, and this unprecedented central bank buying all, pushing gold up.
Precisely. And the consensus is that until these four drivers cool down, until global trust is restored and inflation is truly beaten, gold is going to maintain this strength.
Right. And understanding those drivers brings us to the core of this deep dive. Mapping out the future. Because these global drivers are so volatile, the experts haven't just given one price target for 2026. Instead, they've laid out three distinct plausible scenarios, depending on how all this uncertainty resolves. And this framework is incredibly useful for you as you watch the market. So let's start with scenario A, the conservative view. This is the outlook where things, well, they sort of calm down. What specific conditions would need to happen for the market to follow this more conservative path?
This is the optimistic scenario, really. It requires a major de escalation on two fronts. First, inflation has to be definitively brought under control. That means central banks are cutting rates because they've hit their targets. Second, the geopolitical temperature has to drop significantly. Existing conflicts would need to soften and major international friction would have to ease. If that happens, if the world stabilizes, then gold's main drivers, fear and uncertainty, they just fade away. That rapid upward momentum would stall. And under those conditions, the sources project a gold price target for 2026 of between 1,025,000 to 1,040,000 per 10 gram.
That range is so telling. Even in the best case, most stable scenario, the experts see the current price as the new floor, not a temporary ceiling. They're essentially saying there's little to no price correction coming.
Yeah, it solidifies this idea that there's been a structural shift, the move away from dollar dominance, the ongoing need for a geopolitical hedge. It means the gold market is just fundamentally at a higher level than it was a year ago.
Okay, now for scenario B, the most realistic or expected view. This is the one most analysts are leaning toward. It assumes that the current situation, the slow burn uncertainty, sticky inflation, constant low level friction, it just continues. What are the key forces driving the specific middle ground prediction?
This projection is really powered by two very persistent forces that are just hard to derail. First, that ongoing steady gold buying by central banks we mentioned. They are still laser focused on managing sovereign risk. That's a durable source of demand right there. The second factor, which is absolutely crucial for the domestic Indian price, is the sustained pressure on the rupee. We're pricing gold in rupees, but its global price is in US dollars. So when the US dollar index gets stronger, or when our own domestic conditions put pressure on the rupee, well, it just takes more rupees to buy the same amount of gold.
So, wait, even if the international price of gold in dollars was just trading sideways, a weakening rupee directly pushes up the price for you, the buyer here.
Precisely. And this scenario assumes that this pressure, this sort of steady creeping depreciation of the rupee, continues. When you combine that steady central bank buying with a slow currency depreciation, you get a very powerful, consistent upward trend.
And given those trends, what's the expected price range for this most realistic scenario by 2026?
The sources are pointing to a price range of 1,040,000 to 1,070,000 per 10 gram by 2026. This is the baseline expectation if the market conditions we see today just continue for the next 2 years.
Which leaves us with scenario C, the bullish or extreme case. This is the one that grabs the headlines, but it requires some serious global disruption. What are the severe conditions that could push gold towards these extreme targets?
Here's where it gets really interesting. This scenario needs the global system to genuinely start breaking down. We're talking about a serious intensification of stress. Think about two main triggers: a deep, prolonged global recession, the kind that crushes corporate profits and causes bank failures, or a major escalation in geopolitical conflict that just shatters global supply chains or energy markets.
So, if we see a genuine global financial panic or a massive new conflict, that flight to safety turns from a run into an all out sprint.
Exactly. Under those conditions of just maximized stress, all faith in paper assets, stocks, certain bonds, it just vanishes.
Yeah.
People, institutions, everyone moves to the last safety valve standing. In that kind of black swan event, gold would see a dramatic rally. The extreme target they've outlined is a range of 1,080,000 to euro 2 ambient dollars per 10 gram. And some analysis even suggests it could go higher if the crisis is really severe and drags on.
That breakdown into three scenarios is so clear. It means you can actually track world events and get a sense of which scenario we're drifting toward. So, knowing these three potential paths, the big question is how do you apply this? How do you make a real decision? Let's pivot from prediction to practical strategy using the advice from the sources.
The consensus advice for a long-term investor is actually very clear. Gold is fundamentally an insurance asset. It gives your portfolio stability because it's non-correlated. When your stocks and bonds fall because of a crisis, gold usually rises. It cushions the blow. So the recommended strategy is simple, but it does require discipline. Buy on the dips and hold for the long term. The sources really emphasize that since the underlying trend is so bullish, trying to time the top is just a fool's errand.
But what even is a dip in a market that's trending up so relentlessly?
That's a great question. A dip isn't some massive crash, it's a temporary pullback. Given how volatile gold is, a dip might be a 5% or 7% drop over a few weeks. It might be triggered by some temporary good news, like a positive inflation report from the US. The strategy they recommend is actually dollar cost averaging. Don't try to put all your money in at once. Just commit a fixed amount, say monthly or quarterly, no out of the price. It smooths out your entry point and ensures you're building that hedge over time.
That's great tactical advice. But what about the non-investment buyer? The person who needs to buy physical gold for a wedding or a festival. Should they be watching these scenarios constantly?
The sources address that very specifically, and the advice is different. For jewelry buyers or anyone buying out of cultural need, trying to chase these small price swings is just counterproductive and stressful. The key takeaway is that your need for the gold is more important than trying to time the price perfectly. The long term direction is up. Waiting for a small dip that might never come could mean you end up buying at a much higher price later on.
So for the long-term investor, it's about asset allocation. A stable part of the portfolio, say 10 to 15% for insurance. And for the cultural buyer, need comes before timing.
Exactly. You buy insurance to protect your house, not because you hope it burns down.
Huh.
You allocate to gold to protect your portfolio against global instability.
Okay, let's bring this all together with a final synthesis of what we've learned today.
The overarching consensus is that the gold trend is decisively bullish. We have these structurally embedded drivers, the central bank demand, the geopolitical stress, that are creating a very firm floor under the price. The downside risk, that's scenario A, seems pretty contained. Prices aren't likely to fall back significantly. Meanwhile, the upside potential in scenarios B and C is substantial. It all just depends on whether global instability stays the same or gets worse.
Which means you need to be actively thinking about which path seems most probable for the next 2 years. If you think the world will kind of muddle through, then scenario B is your guide, with that 1,070,000 ceiling. But let's end with that final provocative thought, building on that extreme projection. So, what does this all mean? The ultimate question for the next 24 months is whether we will see the level of systemic global pain needed to trigger that extreme rally. What specific geopolitical conflict, what major financial crisis would be necessary to truly push gold to that ultimate target of 2 lakh per 10 gram by 2026? That is the threshold for true maximized panic. And it's a fascinating benchmark to keep in mind as you watch the global headlines unfold.